Welcome to Get Rich Education. I'm your host, Keith Weinhold. America's homeless problem has become frightening. I describe how that correlates with the housing market, then investing manias. What drives people to spend more for one tulip flower bulb than they would for an entire luxury home, and the lessons you can learn from that'll benefit you the rest of your life from other manias throughout history, all today on Get Rich Education.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Seaford, Delaware to Carmel by the Sea, California, and across 188 nations worldwide. You're listening to one of America's longest running and most listened to shows on real estate investing, along with plenty of ongoing hot takes on wealth mindset and the real estate economy. I'm your host, Keith Weinhold. See, the crash in the supply of available American homes is bad, and it isn't just creating more upward prices. It's a contributor to homelessness. Now, let's talk about some of the drivers of homelessness. Understand the problem a little more. How many homeless people are there in America today? And then what can we do about it? And as you'll see, one prominent real estate industry influencer actually suggests you sell your rental single-family homes in order to help serve the homeless. I've got more on that shortly. Also, I have the results from a GRE Instagram poll. The poll question is, should we pay to house the homeless? And the answers that you, the GRE listeners, gave actually surprised me. I'll give you those super interesting poll results later because I have more to explain there. But first, what is a homeless person? Let's define it. I mean, I think most anyone knows that it's a person without a home, and it's thought of as living on the street. Really then, that person might not be homeless, but houseless in a literal sense. Even if they live in a tent under a bridge, that is then their home, though it might be inadequate housing. So more accurately, the unsheltered or undersheltered population could be more apropos. Then there is vagrancy. A vagrant is defined as a person without a settled home or regular work who wanders from place to place and lives by begging. Okay, so vagrants are part of the homeless population then. This all helps define what we're discussing. Now, the lack of available American housing supply, especially the affordable segment, that is obviously a big contributor to homelessness. For example, anymore, how many builders even construct a new entry-level home for $200 to $250K? Practically nobody anywhere. And just how bad is the supply problem now? Well, the NAR has been tracking housing supply since 1982, and it just hit its lowest level ever this summer, ever. And that's in 40 plus years of tracking. And that's one reason why just last week it was announced that Warren Buffett is making a big bet on housing by investing in home builders. Now, to keep consistent with the same stats that I've been reporting to you for a couple years now, to update this, again, 1.5 million available homes. That's the baseline supply. That's the long-term normal per the Fred active listing count. And through last month, it is still under 650,000. So that's still a housing supply crash of 57% from its peak of 1.5 million. Now, I want you and I to listen to something together. This upcoming piece is a recent interview with NAR chief economist Lawrence Yun from the 8th of this month. Yes, he is the one that basically wants you to sell your single-family rental properties, and he makes his case for an inducement to get you to do this. And he's not proposing anything completely ludicrous. It's really interesting. Listen closely for that. This is about 5 minutes in length, and there's a lot of material here within this clip. It is a nutrient-dense piece, so I've got so much to say about this when I come back to comment.
The US registered its lowest inventory count since the National Association of Realtors began tracking this data since 1982. Well, our next guest says 2023 could go down as the tightest inventory market conditions to have ever been recorded. For more on the state of the housing market, we're joined by Lawrence Yun, National Association of Realtors Chief Economist. Great to have you back on the show here. So let's break down some of this data, because I know you said that the recovery hasn't taken place, but the housing recession is over. So where are we now, and what breaks this holding pattern?
We are in a very unique housing cycle. We saw the buyers pull back initially when the interest rates were much higher, but now the buyers, multiple offers are happening, but the supply is not there. At the same time, the builders are having great time. They're making profits. They're building those empty new units, and they're able to find buyers. So we are in a very unique circumstance, but the inventory clog up, that is holding back the potential for recovery.
And how quickly can home builders ramp up production, especially when you factor in needing to hire workers and to try and meet some of this demand?
The cost of construction is rising. One has to consider, the building permitting process, which may take a very, very long time, especially in some states like California, which will hinder a continuing supply situation. But what really needs to happen is, can we find an incentive, tax incentive, to unleash some of the inventory held by mom and pop real estate investors? There are over 20 million single-family housing units that are rented out. But if we can get even just 1% of those inventory onto the market through tax incentive, essentially reduction in capital gains tax, if it is sold to, say, first-time buyer or with some income limitation, that will spur more supply immediately, and that will help the housing market and the broader economy. So that will be one consideration I think the Congress should seriously consider. But in the meantime, it's about the builders and maybe changing housing family circumstances. Some people have to move, new job, new child, maybe changes in their marriage status, getting married or divorced. All that will also lead to some addition in the supply just from long-term demographic factors.
Now, how likely is that to happen? We already have a very tight labor market. Nobody wants to have to then now take on a higher, mortgage interest rates as well. What sort of timeline could we be looking at when we might start seeing meaningful loosening in terms of the inventory that's out there?
So it's a gradual, steady improvement in inventory, but the big change is either that tax incentive or if the Fed decides to stop raising interest rate. Because one of the reasons for the low supply is that homeowners do not want to trade away their low interest rate for much higher interest rate as they are making their residential movement. But if the interest rate begins to calm down a bit, at least the cost of the move becomes less painful than before. So we could encourage more people to move also by the Fed stopping raising interest rate, especially in light of the fact that Fed has really damaged the regional banks, small-sized banks. I mean, the big banks are fairly immune, but small-sized banks are important for the country, and we cannot further damage the balance sheet of the small-sized banks.
And it certainly doesn't help. We're already seeing, some weaknesses in those regional banks. Moody's downgrading some of the larger banks as well today. But when you look at what people tend to look at, which is the 30-year fixed mortgage, some of the projections for the NAR, 6.4% this year, declining to perhaps 6% in 2024. How much of this pent-up demand are we going to see then start to get released by then?
Oh, yeah, you will see a rush of buyers coming in with lower interest rate. But also, good thing is, again, some of the homeowners who are really liking their low interest rate, well, if the interest rate comes down a bit, they are willing to give up their 3-4% mortgage rate, which they locked into a few years ago. So low interest rate will not only unleash demand, but it will also begin to unleash supply situation.
And Lawrence, where are the deals to be had? Because a lot of people, purchased homes to use as Airbnbs or secondary homes and rentals as well. And, feeling some pressure there as well. Where are the deals to be had regionally in the United States?
Regionally, the Midwest, the most affordable regions of the country, you look at, say, Cincinnati, Indianapolis, the typical median home price at around $250,000. So someone from, say, coastal region, whether from, say, California market, New York, they go into the Midwest, they can buy all cash at times, or the mortgage payment will be very, very manageable. And the job growth in the southern states are very, very strong, whether from Florida all the way to the Carolinas or Texas. Strong job growth is adding to that demand.
Yeah, the NAR chief economist there talking about how, much like I have for years, great opportunity is in the Midwest and southeastern parts of the U.S. with this greater ability for people to work from anywhere. When people move in from the pricey coasts, it is so affordable to them. Moving from Manhattan to Cincinnati feels incredibly affordable. Moving from San Francisco to St. Louis feels like you've upgraded from a serfdom to a kingdom. Moving from Boston to Jacksonville feels like a total life makeover. That's why here at GRE, we're focused on properties in those inbound destinations. And before I continue, especially for those outside the U.S., I know it seems a little odd that Ohio and Indiana are in what we call the Midwest when they're actually in the northeastern quadrant of the nation, but they are in fact Midwestern states. And that fact is rooted in history and cultural tradition. So getting back to some angles on the housing supply crisis, Lawrence Yun, he proposed that a tax incentive be introduced to unleash the inventory of single-family rentals from individual real estate investors. We're talking about people like you. And he said that there are over 20 million single-family housing units that are rented out. Well, if we reduced or canceled the capital gains tax and just got 1% of that inventory on the market, he states that that would help. Well, yeah, but even then, that would only put about 200,000 units on the market, and they would get snatched up so fast with all this demand. Now, if mortgage rates come down to, say, 5%, that would unleash both housing demand and supply, both, like Lawrence Yun says. So it's not apparent that would really help the shortage if both demand and supply go up. In a nation of about 1/3 billion people now, that's how I like to express it this year, America now has 1/3 billion people, also known as 333 million. How many of them do you think are classified as homeless? As you think about that, as you think about how many of America's 333 million Americans are homeless, let me tell you this homeless population figure that I'm about to share with you, it's from HUD, and it's through last year. So it's their latest year-end figure. And I'll tell you, it's hard to believe this number. The Department of Housing and Urban Development states that about 582,000 Americans are homeless. Now, how does HUD do this? Well, they do this in a way that their number is a snapshot of the homeless population as of a single night at the end of January each year. Okay, the total number of people who experience homelessness for some period each year then is going to be higher than that. Now, I just did the math, and that means that based on their figure, it's just 1 in every 572 Americans that are homeless. Come on, do you believe that? That only 1 in 572 Americans are homeless? I might believe that it's something more like 1 in 200 or even higher than 1 in 200. What are your thoughts about that? I mean, even HUD, they would probably concede that there are shortcomings in that stat and that it's only a starting point. That's why they do it by trying to measure one single night. And over the last decade, according to HUD, the homeless population is little changed, apparently, until just this past year. Homelessness is surging in America because the number of people experiencing it in the U.S., that's increased 11% so far this year over 2022. And that would be the biggest jump by far when you look at equivalent government records beginning back in 2007. Now, this 11% homeless jump that I'm talking about, that's according to a Wall Street Journal analysis. They went and looked at hundreds of smaller and local agencies. Well, most agencies, they say that the alarming rise in homelessness is because of the lack of affordable housing and rental units and the ongoing opioid crisis. Inflation is obviously part of that affordable housing problem. Remember, everywhere in the economy, inflation widens the disparity between the haves and the have-nots. To cut some slack to the surveying that you have to do for this, I mean, homelessness can be hard to measure. Some people live on Skid Row, some live in the woods, some homeless people live in their cars, and then some are not interested in being counted. Others are essentially invisible. I mean, if someone is between jobs and needs to couch surf at their aunt and uncle's place for 3 months, well then, are they homeless or are they not? So to be sure, there's a lot of leeway in those numbers, but only 1 in 572 as homeless nationally. That should just be a bare minimum, a starting point in my opinion. Now let's look at homelessness broken down by state. That's really interesting. And as you can see, generally the higher the housing prices are, the more homeless there are. California at 171,000 has the most of any state. That's more than double of the next most, New York. And then Florida is third. But let's break that down by rate. So that's on a per capita basis. So think of this as the highest concentration of homeless. Washington, D.C. They have 65 homeless per 10,000 people. That's not really a state, though. So number one on a per capita basis, it is still California with that highest rate, 44 per 10,000. So California then leads the nation in homeless on both bases, both absolute and relative. When we look at rate, the second highest state is Vermont, third Oregon, fourth Hawaii, and fifth is New York. And then number 6 through 10 on the most homeless per capita are Washington, Maine, Alaska, Nevada, and Delaware. Now, strictly anecdotally, you've probably seen just what I've seen in the past year plus. You see more visible homeless people in your cities and in other cities. The state with the fewest homeless of all 50 states is Mississippi. And see, housing is quite affordable there. In fact, Mississippi is one of the most affordable states in the nation for housing. So there is at least some correlation between your cost of housing and your homelessness rate. Now, recently on our Instagram page, and the handle there is easy to remember, it's Get Rich Education. If you want to participate in future polls, you can check that out. We ran a poll on homelessness. Here is the poll question that we ran, and I'd like you to think about your answer to this as well, okay? Should we pay to house the homeless? That's the question. And in polling, the way that the question is phrased, of course, can skew your answer. See if instead this question were phrased as, should the government house the homeless? Well, then you might get more yes answers, even though effectively it's the same question because you fund the government. But the question, as we phrased it, is, should we pay to house the homeless? And it also showed a photo of vagrants on a street curb under the question, which might steer the answer a little bit. Well, here are the results, which surprised me to the question, should we pay to house the homeless? Those answering yes were just 6%. The no's were 45%. And we also had a third option. That third option, rather than just a yes or no, was it's complicated. 48% answered with that option. So again, just 6% of you said we should pay to house the homeless, and 45% said no. 48% said it's complicated. In a way, that makes sense to me since we have a largely entrepreneurial, self-made type of audience here. I thought that might have happened. But the thing that surprised me is in how emphatic and overwhelming it was. It was a landslide. 7 to 8 times as many of you said we should not pay for the homeless as those that said we should. Well, the reason that I added, and I am the one that ran the poll myself, they're really quick and easy to do, I added the paying to house the homeless, it's complicated option because it is complicated, and that was the most popular answer. I mean, why should you go to work and pay to house a stranger that has no income because he or she doesn't want to work? But what if they're disabled and they can kind of work, but not really work, or there's a zillion other complications? Substance abuse is obviously a big problem that keeps homeless people homeless, and there is a substantial thought paradigm that says, if they're an abuser, then why would I pay for their housing? Substance abuse is just one reason that there is a population that's voluntarily homeless. They don't want to have to comply with a group homes ban on substances. I wanted to address the homeless problem somewhat today because here we are on episode 463 of A Real Estate Show, and this is the most that we've even discussed it. I think the perspective it gives you is that it helps you be grateful for what you've got. But it is an abundance mentality here at GRE. You can be grateful for what you've got and at the same time be interested in growing your means. What else would help with more housing supply, which would also move us toward mitigating the homeless problem? Well, we've already discussed a number of them, so I'll only go in depth with some fresh angles here. Obviously, more home building is going to help. We've done episodes on how 3D printed homes are not the answer, and shipping container homes are not quick, easy answers either. Tiny homes might be, but then again, you get into the zoning density problem. Just last week, my assistant brought me this MarketWatch article that reported that the average American home size is shrinking just a little, and that oftentimes new build houses now tend to be a little closer together. And really, that's what gets us into relaxing zoning requirements. But you know something? Okay, this is going to be interesting. You and I should do this together here. This plays into NIMBYism, not in my backyard. Community saying that they don't want high-density housing built next to them. Now, I think that there are a lot of critics of NIMBYism, but the criticism comes from people typically that live far out of that area and are not affected by what they're talking about. So let's just play a fun little experiment together, you and I here. Let me paint a picture of a fictitious and idyllic life for you and just place yourself there. Say that you live in a nice single-family home. You're on just a quarter-acre lot, so not a sprawling estate, but you've got a good measure of privacy that way. So you're in a single-family home, quarter-acre lot, and two-car garage. That's basically classic suburbia. And just 100 yards away from your home, there's a big, wide-open field where you walk your dog and you use it as a little makeshift golf driving range or whatever. Nice open space nearby, all right? You've got a fairly idyllic life there. And we'll say it's always been this way since you bought your home here years ago. Suddenly, in your neighborhood of all single-family homes, you learn that they want to build a bunch of fourplexes in that same nearby lot, that only nearby open space where you used to throw tennis balls to your dog. What can that do to your quality of life and your home's value now that a bunch of fourplexes and eightplexes were built nearby? Well, it reduces your home's value because now there are less valuable high-density properties nearby. It also increases the amount of traffic and even noise in your neighborhood. And now you can't use that nearby park anymore at all because it's been all built up with these higher density apartments. All right, that experiment's over. So now let me get back and ask point blank. Did you really want all those new high density developments right near your home? See, if that made you uncomfortable, that is NIMBYism. So it's quite natural to evoke that feeling type. That's why I wanted to go through that exercise with you. You're just a human being. How else can we increase housing supply to help reduce homelessness? Not with rent control, because over time, capping the amount of rent that a landlord can charge, that gives property owners no incentive to improve their property, and neighborhoods end up dilapidated once they've had rent control imposed over a long period of time. We need more training for tradesmen and laborers. How about training the homeless to be tradesmen and laborers? But then someone's got to pay for that training. Another measure that's become ridiculous is that we've got to relax these excessive safety requirements in home building. Now, some safety is good, but it takes longer to build the home and you have to pay more for a home with all this safety stuff. I mean, when every single family home, entry level all the way up to luxury, and they all have to have fire-rated shingles and fire-rated doors and GFCI outlets and smoke detectors in every room and carbon monoxide detectors all over the place. Sheesh, well, that raises the cost of housing for absolutely everybody. In some earthquake-prone areas, you've got to have seismic restraining straps on your water heater, or you can't even sell your home. I mean, do you know how big of an earthquake it's going to take to damage your water heater like that? And you know what? Someone on the other side of that argument, we'll call them an excessive safety proponent. They might say, yeah, but did you hear about that one family that died 10 years ago that would have lived if they had carbon monoxide detectors? Well, the counter argument to that is, yeah, but what about all the homeless people that were exposed to the elements and died in the cold because they couldn't afford the most basic housing, the prices of which have escalated for all this excessive safety stuff? Are you saying that a middle-class person's life is worth more than a poor homeless person's life? See, that's the counter argument there. So again, some safety is good, but we have gone overboard in too many places in housing and beyond, just elsewhere in society. Rising housing costs keep people homeless. A few weeks ago, I did that episode about escalating insurance costs. I now own some properties that have extremely low mortgage rates, such that, well, the insurance has gone up to the point where I pay more in monthly escrow expenses than I do in principal and interest. But hey, I'm not homeless, and if you're listening to this, neither are you. So when it comes to helping the homeless in the short term, you know, it's that campaign that's called Give Real Change, Not Small Change, and that really resonates with me. Don't give $5 to a vagrant on the corner. That just keeps them showing up at that corner. Plus, they're going to spend your $5 on a cheap bottle of Monarch vodka. Instead, if you're going to give directly to the homeless shelter or the soup kitchen. And that's what's meant by give real change, not small change. And that's something actionable that you can do. Coming up next, investing manias. How wild it gets. Paying more for a tulip flower than a single-family home. Shooting and killing someone over a Beanie Baby toy. And then I'm going to wrap it all up with what this has to do with your cycle of investor emotions. Now, I'll tell you, around here, we don't run ads for the Swiffer. This week's sponsors that support the show are people that I've personally done real estate business with myself, and I've benefited from them. Ridge Lending Group, they specialize in investment property loans in nearly all 50 states. You can start your pre-qualification at ridgelendinggroup.com, just like I have. And then for super passive real estate returns, check out Freedom Family Investments. Right now, what you can do is just text family to 66866. I'm Keith Weinhold. You're listening to Get Rich Education. You know, I'll just tell you, for the most passive part of my real estate investing, personally, I put my own dollars with Freedom Family Investments because their funds pay me a stream of regular cash flow, and returns are better than a bank savings account, up to 12%. Their minimums are as low as $25K. You don't even need to be accredited for some of them. It's all backed by real estate, and I kind of love how the tax benefit of doing this can offset capital gains and your W-2 job's income. And they've always given me exactly their stated return, paid on time, so it's steady income, no surprises, while I'm sleeping or just doing the things I love. For a little insider tip, I've invested in their Power Fund. To get going on that, text family to 66866. Oh, and this isn't a solicitation. If you want to invest where I do, just go ahead and text family to 66866. GRE listeners can't stop talking about their service from Ridge Lending Group and MLS 42056. They've provided our tribe with more loans than anyone. They're truly a top lender for beginners and veterans. It's where I go to get my own loans for single-family rental property up to 4plexes. So start your pre-qualification and you can chat with President Chaley Ridge personally. They'll even deliver your custom plan for growing your real estate portfolio. Start at ridgelendinggroup.com.
What's up, everyone? This is HGTV's Tarek El Moussa. Listen to Get Rich Education with Keith Weinhold, and don't quit your daydream.
Welcome back to the GRE Podcast. I'm your host, and my name is Keith Weinhold. If you've got a friend or family member that you think would benefit from the knowledge drops here on the show, you can simply tell them to grab the free Get Rich Education mobile app. That's a convenient option for listening every week for both iOS and Android. Today's topics of homelessness and investing manias could very well bring in a new audience onto the show here. So a little more about my backstory. I'm from Pennsylvania, but I got my real estate comeuppance in Anchorage, Alaska, of all places, and I grew out nationally and internationally from there. I had humble beginnings, and I wasn't born anywhere near wealthy. I had to figure out how to build it myself. But see, if I were born wealthy, that might have been somewhat of a disservice. I wouldn't have learned how to build it, and then I wouldn't be of much help to you either. And likewise, if you are now out there building it yourself, you're going to be able to help others too. By the way, I was born in the same Pennsylvania town as Taylor Swift, though she and I don't have much else in common. I guess that she and I are both best known for using a microphone, though I think that I'm about as likely to start using this microphone to sing into your ears like Taylor Swift does, as Taylor is to launch a real estate investing show. For hundreds of years, the tulip has been one of the most loved flowers in the Netherlands. It's an enduring icon, as synonymous with the country as clogs, windmills, bicycles, and cheese. The tulip has a long and storied history, including the infamous shortage in the 1600s known as Tulip Mania. And if you're someone that has even a fleeting interest in investing, you should at least know what this is. Tulips started to appear in Europe in the 1500s. They arrived from the spice trading routes, and that lent this sense of exoticism to these imported flowers that look like no other flower native to the continent. It's no surprise then that tulips became a luxury item destined for the gardens of the affluent, and according to the Library of Economics and Liberty, it was deemed a proof of bad taste in any man of fortune to be without a collection of tulips. Well, following the affluent, then the merchant middle classes of Dutch society, they sought to emulate their wealthier neighbors, and they started demanding tulips. So to start out with, it was purchased as a status symbol for the sole reason that it was expensive. But at the same time, tulips were known to be notoriously fragile. They would die if they weren't carefully cultivated. And in the early 1600s, professional cultivators of tulips, they began to refine their techniques and then grow and produce the flowers locally there in the Netherlands. They didn't have to rely on international trade for them anymore. So they established a flourishing business sector there in the Netherlands, and it still persists to this day. Well, by 1634, Tulip Mania had swept through the Netherlands. The Library of Economics and Liberty writes that the rage among the Dutch to possess tulip bulbs was so great that the ordinary industry of the country was neglected, and the population, now even to its lowest dregs, embarked in the tulip trade. Okay, so now everyone is in, rich and poor, and, it can be a little hard to say for sure how much people paid for tulips. But there's a Scottish journalist named Charles Mackay. He wrote an extremely popular 1841 book, and you probably heard of this book. It is called The Memoirs of Extraordinary Popular Delusions and the Madness of Crowds. And that book, it does give some points of reference, such as the best of tulips cost upwards of $1 million in today's money, but a lot of bulbs traded in the 50 to 150K range. By 1636, the demand for the tulip trade was so large that regular markets for their sale, kind of like a little Dow Jones Industrial Average, well, that got established on the Stock Exchange of Amsterdam, and then in Rotterdam, and in Haarlem, and in other towns. It was at that time that professional traders started getting in on the action. That's all that some people do now, is trade tulips, and everybody seemed to be making money simply by possessing some of these rare tulip bulbs. There were Dutch speculators at the time that spent incredible amounts of money on bulbs that only produced flowers for a week. many companies were now formed with the sole and exclusive purpose of trading tulips. And to everyone at the time, it just seemed like the price would just continue to go up, up, up forever. Well, pretty soon, demand for the tulips exceeded the available supply by so much that people were now buying futures contracts. Okay, that's like you're basically saying, I'll pay you this much money today for a tulip that you provide to me in 3 years. Well, by the late 1630s, these futures contracts, they were like a crack. Okay, that's a crack that started to appear in the price run-up, like a pin that began to prick the bubble. Demand began to wane when people were just buying a token for a future tulip that hadn't even started growing yet, okay? And people felt like they weren't buying anything tangible anymore. That's one factor that helped create an oversupply of tulips in the market and started depressing the prices. Supply caught up with and exceeded demand. And a large part of this rapid decline was driven by the fact that people had purchased bulbs on credit, hoping to repay their loans when they sold their bulbs for a profit. But once prices started to drop, well, the holders were forced to sell their bulbs at any price and declare bankruptcy in the process. So people had begun buying tulips with leverage, using margined derivatives contracts to buy more than they could afford. But as quickly as the run-up began, confidence got dashed. By the end of 1637, that's when prices began to fall and never recorded. That was it. The bubble burst. Buyers announced that they could not pay the high price previously agreed upon for bulbs, and that made the market fall apart. While it wasn't actually a devastating occurrence for the entire nation's economy, what it did was undermine social expectations. The event destroyed relationships between people that were built on trust and people's willingness and their ability to pay. It's been said that the wealthiest merchants to the poorest chimney sweeps jumped into the tulip fray, buying bulbs at high prices and then selling them for even more. Well, this is what can happen. And today it happens with financialization and nothing real that backs up purchases. So Tulip Mania, it's a model for the general cycle of a financial bubble. That's what happened with Dutch tulips. Now, here in more recent times, similar cycles have been observed in the price of Beanie Babies, baseball cards. I mean, I got caught up in the baseball cards as a kid, owning more than 100,000 baseball cards at one time, and also NFTs, non-fungible tokens, and shipping stocks. The example of Tulip Mania, though, you should know about that because that's now used as a parable for other speculative assets like some cryptocurrencies or .com stocks from the year 2000. So when you hear someone likening an investment to a Dutch tulip bubble, now you'll know what they're talking about. It is a symbol of excess and greed and FOMO. But there has been a good bit more modern scholarship, however, that tells us that Tulip Mania, it did indeed occur in the 1600s Netherlands, but that the tale has been exaggerated. And it's something that the upper classes of society were mostly involved in. That's where popular scholarship is really leading us today. The tale is somewhat exaggerated, but it did happen. So that's the Dutch tulip bubble. Now, for a more modern day parable about an investing mania, there is a new movie out right now about the rise and fall of Beanie Babies. It's on Apple TV Plus. And these things, Beanie Babies, they were these little stuffed plush toy animals, and they became more popular among adults than children. Yeah, the rise and fall of Beanie Babies, these toys that people mistakenly thought would make them rich. The name of the movie right now on Apple TV Plus is called The Beanie Bubble, and it is a mostly true account of these lovable, I guess, little toys boom and bust in the 1990s. It's kind of comparable to the meme stock frenzies that took place during the pandemic. So they were these $5 pellet-stuffed plush toys that ended up having astronomical appreciation estimates. Stripes the Tiger, released in 1996, that was predicted by collectors to skyrocket from $5 up to $1,000 by 2008. So there were a lot of forecasts out there like this that were so enticing that one dad invested his kids' college funds into Beanie Babies, thinking that later he'd resell them for some big profit. And at the height of the frenzy, people were ruining relationships and committing felonies to get their hands on some of these little sacks of fuzz. Border officials confiscated more than 8,000 smuggled Beanie Babies at a U.S.-Canada border crossing in 1998. A West Virginia man shot and killed a former co-worker in 1999 after an argument that was partly about $150 worth of Beanie Babies. And that same year, a divorcing couple couldn't agree on how to split up their collection, so the judge made them divvy up the toys in person right on the courtroom floor. So how did all this ludicrous stuff happen? How did this Beanie Babies run-up occur? I mean, barely anyone cared about them when this company called Ty Incorporated launched them in 1994. Stores only started getting lines out the door for them once the toy's creator, he's now a billionaire named Ty Warner, once he began kind of pulling strings to juice demand. Okay, here's what Warner did. So here's how you induce people into a speculative bubble that gets them to do those crazy things. What he did is he refused to stock Beanie Babies at Toys R Us or Walmart, and instead he created this illusion of rarity by only selling them at small toy stores and independent shops. And even if you did find a retailer, every store supply of Beanie Babies was limited to just 36 of each animal. So inventory restocking drew a crowd. Well, all that, combined with the owner, Warner's decision to start retiring certain animals in 1995, that created an artificial scarcity and this mass panic to stock up on Beanie Babies. And soon an aggressive resale market was born, and it was complete with magazines and blogs and even trade shows for these Beanie Babies. One woman, she had a guide to the secondary Beanie Babies market, and it got so popular that she was selling 650,000 copies per month. And on a lot of days, she did 2 or 3 radio interviews before her kids woke up for school. And Ty Incorporated later gave her an award for boosting their sales. So at peak Beanie Mania, Ty Incorporated and legions of speculators, they actually made hordes of money. The stuffed animals accounted for 6% of eBay's site-wide sales in 1997 and 10% of them in 1998. And their average resale was $30, 6 times the retail price. But supposedly rare ones like the Princess Diana bear, they went for hundreds or thousands of dollars. And now you can find one online for $15. But Ty Incorporated, the manufacturer of these things, hit $1.4 billion in sales in 1998. I mean, that's what Mattel grossed in Barbie dolls in 1995. And at the end of the year, Ty Warner gave all 250 employees holiday bonuses that were equal to their annual salaries. Well, most regular people, they didn't sell their Beanie Babies at their peak price, right? It's really difficult to time a market. So unfortunately for them, the hype subsided, and anticipating a drop in interest as more kids reach for newer toys like Pokemon, Ty Incorporated announced it would stop making Beanie Babies at the end of 1999, and that really poked a hole in collectors' whole "this will never not be popular" mentality, and that sent prices and demand plummeting. So there were no underlying fundamentals to Beanie Babies' value. That's all that I've got on that speculative craze. No fundamental value. So let's review how this happened with both wild speculative crazes, Dutch tulips and Beanie Babies. Really what happened is we follow this through is that investors lose track of rational expectations, and then you got these psychological biases that lead to a massive upswing in the price of an asset or a sector, and a positive feedback cycle keeps inflating prices. And pretty soon investors realize they're just holding this irrationally priced asset backed by nothing. Prices collapse due to a massive sell-off, and then overwhelming majority of the people deeply involved go bankrupt. Now, a lot of stock market investing is based off of this buy low and sell high mentality, And stock investors, they can get caught up in similar crazes like this. But because a lot of stocks, they are tied to productive companies, so the stock investor deals with smaller bubbles. A lot of times, a stock price can double, triple, or even 10x, even though that company's not profitable. All right, but buy low and sell high. All right, well, that sounds easy, but why is this harder to do than it sounds? That is what is called the cycle of investor emotions. All right, and what the cycle of investor emotions starts with is you start feeling optimistic. And that's because you hear about, we'll just say 10 or 20% stock returns. Let's say that you aren't fully invested in the stock market, but some friends are, and they're achieving small gains. Well, next you feel excitement. The market is now up some more. And hey, what's in motion tends to stay in motion. More of your friends are now telling you how much money they're making, and you're soon experiencing a full-blown case of FOMO, fear of missing out. And then the next stage is called thrill. It's the thrill that you feel. So you jump into the stock market and you fully rationalize that with something like, you know what, I'm a momentum investor. That's what I'm calling myself. That's how I validate this. That sounds pretty good, I guess. And now that you're in, it actually feels fantastic for you for a short time. You figure that on some days you are making more from stocks than you are your job. Winning activates dopamine. Dopamine, that's a brain chemical that's known as the feel-good hormone. It gives you a sense of pleasure. It also gives you the motivation to do something when you're feeling the pleasure. So then you add more shares, and now you're doing it at an elevated price until you are fully invested in stocks. Now everyone is making money, even your Uber driver. Well, the next stage is called euphoria. This is the peak, but you know what the peak is? The peak is also the point of maximum financial risk. All right, now let's drop back. Remember the simplicity of buy low and sell high? Well, then at this point in my story, savvy stock investors should now be selling right here at the height. Now be selling? Leaving the party at its crescendo? Stopping the dopamine flow? Yes, exactly. And that's why it's so difficult. Well, what happens after the stock market peak? Well, it's overbought with bloated price to earnings ratios. And let's say here in our example, the market soon drops 10% from its recent high. That's what's known as a correction, a drop of 10% or more. And now you're feeling the next stage called anxiety. Okay, your dopamine flow is stifled. Next, you tell yourself, well, I shouldn't be worried because I'm a long-term investor. But now it's down 15%. And now you're experiencing the next stages, denial and fear. Now you're checking the Robinhood app almost hourly to see if it's going to recover. And then next comes the stages of both desperation and panic. Stocks are down 20%, which is the definition of a bear market. And now you are devoting more mind share to this each day than what's healthy for you. And then there's the next stage, capitulation. Down 30%, you finally surrender to a fear of further loss. I mean, you're just getting so sick of months of losing with a down drain in stock prices in this example. So you finally just do it and you cash out your stocks into a safe money market fund. Now you're out. And the way that you rationalize and justify doing this is because you tell yourself, hey, you know, when I wake up tomorrow, I'll know that I haven't lost money again, and that gives me certainty. Well, the next stage in the cycle of investor emotions is despondency. Now you realize that what you've done is the polar opposite of successful investing. It is complete. Now you've bought high and then sold low, and next, stocks completely bottom out. But when stocks completely bottom out, this is actually your point of maximum financial opportunity. Instead, you should be buying, but you can't because you're experiencing that next investor stage, depression. You are so full of contempt for the situation that the idea of actually buying at bargain basement levels again is simply inconceivable. You've been burnt badly. And then the next stage is open relief actually begins to arrive for you. The market has begun ticking up after the crash, and it soon should be clear that share prices are actually fairly valued again after a while. But you know what? You don't buy the recovery story. You wait until enough price growth occurs that you're feeling the stages of confidence and optimism again. Now we've come full circle because we began this at optimism. You wait until that's experienced before you even consider getting back in and buying, and the pattern just repeats. So that is the cycle of investor emotions. And there is an average of 3.5 years between each stock bear market, by the way. And of course, I've been kind to call all of this investing. It is really more like speculating. But here's the real problem. Most investors think that they're better than average stock pickers, so they keep playing this game. And this effect actually has a name. It's called illusory superiority, like when you think that you're better at something than you are. It's like how at least 70% of people think that they're better than average drivers, despite the statistical impossibility. I mean, even professional money managers fall prey to this cycle of investor emotions. Fewer than 10% of active U.S. stock funds manage to beat their benchmarks. And it was the renowned British economist and value investor Benjamin Graham that once said, "The investor's chief problem, even his worst enemy, is likely to be himself." That's Benjamin Graham. Well, as real estate investors, we largely sidestep that entire cycle of investor emotions for a bunch of reasons. Real estate returns are more stable. So we sidestep this emotional roller coaster. Not only do we have stable prices, but appreciation is one of just 5 ways that you're simultaneously paid. Real estate also has monthly income. Dutch tulips or beanie babies, they don't pay you a durable monthly income stream. They don't provide an income stream at all. And finally, real estate is a real asset. There's real backing here because it fulfills a real human need. So I hope that you've enjoyed this journey through speculative bubbles today and how that plays into human psychology and investor emotions. Go ahead and tell a friend about Get Rich Education. And if you've got a friend or family member that you think would benefit from the knowledge dropping here on the show, you can simply tell them to grab the free Get Rich Education mobile app. That's a convenient option for listening every week for both iOS and Android. My name's Keith Weinhold, and I'll be back with you right here next week. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.